Welcome to Geojit Spotlight, where we bring you expert insights to navigate the ever-evolving world of finance and investments. Today, to share his insights, we have with us Dr. V.K. Vijayakumar, Chief Investment Strategist at Geojit Financial Services. In this engaging session, we plan to look at the year that was 2024, the year that could be year 2025, to talk about the various investment strategies and even look at some sectoral picks that could lead the investors to the new year. Welcome, Dr. V.K.
Thank you, Sony.
At the outset, let me just ask you how the year 2024 was. It would be a tale of two halves, if I'm not mistaken. But overall, when you look at the year, I would say the year has given decent returns to the stock market investor.
Yes, the year 2024 has been a very good year for stock markets globally. A very good indicator of the performance of stock markets globally is the MSCI World Index. MSCI World Index has, till now, year till date, given 20% returns. 20% is very good. But then there are big regional variations if you look at the returns. For example, Europe has been sluggish with only a 9% growth, around 9%. Euro stock index has given only 9% returns year till date. Japan has done well with 19%. In India, as you rightly said, it has been a story of two halves. There has been a correction of more than 10% from the September highs, but the market has again rebounded. And as we speak now, the year till date return is around 15%. This comes on top of the 20% returns that we got last year. Therefore, we have to say that the returns has been good. But then the best performing market in the world this year is undoubtedly the US market. The US S&P 500 has given 28% returns year till date. 28.
Even better than emerging markets.
Yes, far better than emerging markets. Far better than emerging markets. If you take NASDAQ, the tech-heavy NASDAQ, the year till date return is 34%. So US market has beaten all other markets by a wide margin. But then generally, we can say that the return has been good in the year 2024. And to understand this performance of the markets in 2024, globally, we have to also understand what led to this good performance. In India, as we know, if you take the last 4 years, Nifty has more than tripled from the COVID lows. COVID low was 7,511 in March 2020. Now it is north of 24,000. So the Nifty tripling, more than tripling in 4 years' time, 4.5 years' time is excellent returns. Globally, actually, for the 2024 performance, 3 factors contributed. The first is the global economy has stabilized. We know global economy was impacted by 3 shocks. First was the 2020 COVID shock, which led to global recession, which impacted the markets also. Then we had the Ukraine war, which triggered high inflation globally. And this high inflation was countered by the central banks by hiking the interest rates. We had an ultra-tight monetary policy being followed by all the central banks. So that created slowdown in economies, because when you have rising interest rates, economies will slow down. And also it was feared that as a consequence of the tight monetary policy being implemented by the American Central Bank Fed, the US might fall into a recession. In fact, the consensus opinion among economists was that US has a very high probability of tipping into recession in 2023. It did not happen. The US economy has been surprisingly resilient. Yes. So that is another factor. And perhaps more important than all this has been the rate cutting cycle initiated by the Fed this year, 2024. one by 50 basis points, the second 25 basis points. Fed is likely to cut the rates by another 25 basis points. So it will make it 3 rate cuts, totaling 100 basis points in 1 year. So when interest rates, we know interest rates and stock market performance are inversely correlated. So interest rates have been coming down and markets have been booming. These three factors contributed to the very good performance of stock markets globally in 2024.
So when you talk about Indian markets in particular, of course, as you said, we've seen the momentum slowly coming down, and in sports terminology, we always say if the momentum is with you, it always looks good for the future. But especially in the last 6 months, we've seen trading volumes, investor volumes coming down. The momentum has slowed a bit down. Now, what do you see in 2025? How do you see the stock markets progressing in 2025?
Well, I agree with you on the momentum part. The momentum has come down because we had this almost one-way rally. Because normally when you have a big bull market, there will be big corrections in between, even 20% corrections and a series of 10% corrections. We did not have any serious corrections, but till
So investors were also spoiled, you would say?
investors were spoiled actually, particularly the newbies who came to the market after the COVID crash. They haven't experienced any bear market. So their impression is that the market is steadily moving up sort of thing. So that feeling has been questioned by the recent corrections, more than 10% correction that we had from the September highs. Well, going into 2025, well, I believe that this stage of this early stage of this bull market, of course, this is the longest bull market. Actually, in terms of the longevity, this bull market has surpassed the 2003-2008 bull markets. Even though going by the price-wise movement, that was far superior. But in that phase of this sharp, resilient growth in the market, that phase is over. And therefore, in 2025, it would be more realistic to expect a moderate returns from the market. When I say moderate returns, well, I will have to qualify that. As you rightly said, last year was a year of two halves. 2025 also can turn out to be a year of two halves, because in the initial couple of months at least, the market is unlikely to rally in a sustained manner, because there are some major headwinds which the economy and the markets are facing. But then if there is a recovery in the economy and recovery in corporate earnings, and if we have leading indicators suggesting a recovery in the economy and corporate earnings, well, there can be a sustained rally. But as of now, at least in the initial months, the 2025 prospects appear a little bit challenging. So I would say, of course, for the long term, India investors should be bullish, because we all know, we have emphasized this point many times. India will be the fastest growing large economy in the world for many years to come. 8 trillion GDP, 10 trillion market cap by 2032. There is a near consensus on that. Therefore, investors should continue to invest. They should continue to invest systematically through mutual funds, SIPs and all that. But since you asked me about the prospects of 2025, I would say it would be more realistic to have moderate expectations, because the economy has touched a soft growth path. The Q2 growth numbers surprised everyone on the downside, with only 5.4% GDP growth. And perhaps more importantly, the Q2 earnings growth is flat. There is no earnings growth at all. So when you have a slowing economy and corporate earnings being flat, that will not gel with a booming market. That's why I said we should be more moderate in our expectations. as far as 2025 returns are concerned. That would be more realistic.
Right. You were talking about the economic numbers that are coming out. So, specifically, when we talk about the GDP growth rate, the sequential GDP growth rate has been coming in lower. Uh, do you want, or do you see the government and the financial authorities playing a more important role in 2025? Because you look at the GDP growth rate is coming down. Of course, to boost that, the government has been very tight on the fiscal deficit number. So do you think they should be loosening it? From the RBI side, do you think they should be cutting the interest rate? So this will all help in boosting the earnings growth, as you were saying. So do you see, or do you want the government to play a more consumption oriented role or a growth oriented role in the markets?
A very relevant question, sorry. Very, very appropriate. Yes, you are right in your analysis that there is a slowdown. And when there is a slowdown, there are typically two responses to that slowdown. One is the fiscal response from the government through fiscal stimulus, spending more money. And second is the monetary response from the central bank. That is, the central bank cutting interest rates and providing the monetary stimulus. Both are likely. The fiscal stimulus is already happening. The government is aware of the slowdown. One very important point that we have to understand is the fiscal tightening was not deliberate. The fiscal spending slowed down. Actually, the budget, as you might be knowing, had set apart 11.11 lakh crores for infra spending. But then because of the elections, and also partly because of the unseasonal rains in August, a lot of infra spending was constrained.
It could not spend, yeah.
It did not happen. So the fiscal expenditure till last month was running negative by 33% compared to earlier years. So the fiscal tightening was not deliberate. Fiscal expenditure had to be slowed down because of this. And now the government is doubling down on that. The CEA, Chief Economic Advisor, had already explained at this point. The Finance Minister also emphasized this. So the fiscal stimulus is already happening. And we would be happy to see more fiscal stimulus through the budget also. Some measures to boost consumption. And as far as the monetary stimulus from the RBI is concerned, I am fairly optimistic that in February, the RBI will be cutting policy rates, repo rates and reverse repo rates. And we have the new RBI governor from the finance ministry. So that also will be helpful, at least in the short run. And also inflation has come down. November in CPI inflation print is 5.8%, down from the 6.21% in the previous month. So theoretically, we can say the latest inflation print is within the RBI's tolerance band. Therefore, they are in a position to cut the repo rate and the reverse repo rates, which they will certainly do, apart from the CRR cut, which they have already implemented.
So you were talking about expecting moderate returns in 2025. When you talk about the key risks to our estimate, we've had in 2024 geopolitical tensions were, I think, in limelight. Russia-Ukraine war has been going on for a long time now. In the Middle East also, you see some tensions coming up. So what are the key risks to our estimate? So, I mean, it could be, let's say, a tale of two halves, as you said, expecting moderate returns. Now, what are the key risks that you see in 2025 which could impact our estimates?
Normally, geopolitical tensions, particularly wars, used to impact the markets very seriously. For instance, if you had some problems in the Middle East, it will immediately impact crude prices, and crude prices shooting up will get reflected in the cost of push inflation, and the central banks will have to raise interest rates. That was the pattern. That pattern has completely changed. In spite of the wars in Middle East, tensions in Middle East, crude prices are stable. And there is a reason for that. The largest producer of crude oil in the world now is not Saudi Arabia, it is the United States of America. Therefore, the power of OPEC to influence crude prices have come down substantially. So that's a very significant point. So geopolitical tensions like wars have not been impacting the markets. But then there are more serious concerns in 2025. One risk I already explained, the growth slowdown and the corporate earning growth slowdown. The important question now is whether this growth slowdown is a one-off, a temporary phenomenon, or is it a structural issue? If it is a structural issue, it can be a big problem, but I don't think it is a structural issue for the reasons I have already explained. The government expenditure increases, automatically growth will come up. But the other issue, I don't know whether to call it geopolitical, it will be more economic. The most uncertain factor, the unpredictable factor in 2025 is going to be President Trump, because Trump, is a mercurial personality, sort of maverick. He is not a conventional politician, and he has already declared openly that he will increase the tariffs on imports from China. But then I'm a person who believes that economics will trump President Trump, because there is no way you can increase the tariffs on Chinese imports by 30% and get away with that, because Chinese goods are widely consumed in the US, except the food items. Most of the other items, if you go to a mall in US, for instance, most of the goods are Chinese goods. So if you impose 30% tax on Chinese imports, that means it will get reflected in inflation. So higher inflation means the Fed's policy of soft landing the US economy will go for a 6. Therefore, even if Trump wants to, it is unlikely. So this is more a political posturing. Maybe he will start raising rates by 10 to 20%. But then President Trump being what he is, you can never say what will happen. So if he increases the rates on Chinese imports, of course he will be raising imports on the raising taxes on imports from Mexico, Canada, perhaps even Vietnam. India is unlikely to come in the first targets, even though he has called India the tariff king. He is unlikely to do that because of the political equation also. But then India also has some concerns. So if this is one very important factor to be kept in mind, if he raises the tariffs on Chinese imports, and if China retaliates, that can lead to a global trade war, and the trade war will have very bad consequences for the global economy also. That is the risk in the market, the biggest risk in my opinion in 2025.
Perfect. So, coming to our strategy, what to do. I remember in the beginning of 2024, you were advocating a multi-asset allocation strategy, which I think has worked out very well, especially during times of volatility. What would be your suggestion to our investors? How to go about with their investments in 2025? What should be the strategy they should have going forward?
Well, our multi-asset investment strategy, as you said, has paid rich dividends because the market has done well. Gold has also done exceedingly well. Therefore, I would suggest even now the continuation of the same strategy, multi-asset strategy. This year we will have the added advantage of rising bond prices also. As I said, RBI is likely to cut rates. So when interest rates are brought down, bond prices will increase. So investments in debt instruments also will give good rewards. So the same policy can be continued with a higher weightage to stocks when we have indications that economic growth is rebounding and corporate earnings are rebounding.
Specifically coming to the stock market, which are the areas you think the investors should focus on, specifically which sectors to look at? 2024 has been a roller coaster of, a lot of seasonal picks, seasonal sectors. In 2025, anything that comes to your mind that you would like to share with our investors?
In 2023, we suggested the capital goods, and they did very well in 2023. 2024, initially our sectoral pick was automobiles and also financials also. Automobiles performed well in the first half. After that, we have a slowdown, particularly in some segments of automobiles, not in all segments, in some segments. Financials have started performing very well during the last 2 months, particularly they are doing well because the FIIs have turned buyers, and when they buy, they will be buying this high quality large caps in financials. So our sectoral picks continue to be financials, one segment, because that segment is even now relatively fairly valued. But I believe that 2025 will be a year of specific stocks. It will be investment strategy should be more stock specific rather than sectoral oriented. But then always there will be a scope for a better performance from certain sectors. One sector which has been doing very well, and we recommended some of the stocks in these segments way back in 2022. I'm talking about the digital space, the consumer facing digital space, stocks like Zomato, which we recommended at around 51, 52 rupees. That's turned out to be a multi-bagger. And then Paytm, after the initial disappointment, it has again bounced back. Then PB FinTech, all these are in the digital space. The reason why I'm optimistic about this digital space is that this is one space which will continue to grow. For example, we know there are segments like FNCG where you have a growth slowdown. Even in the urban areas, the volume growth has come down. Similarly, in metals, we have a slowdown thanks to the Chinese dumping. But then these are segments where growth will be very strong, more than 30%.
There is a lot of IPO interest also in this.
IPO interest also is there. Of course, I must confess that the valuation comfort is not there in that because valuation is very high because market knows that the results will be good, quarterly results will be good, and these companies have a long runway for growth. But then how long will be the runway for growth? The market always discounts. Market will not discount what is going to happen 5 years from now. Market will discount what is likely to happen in 2025, 2026, not beyond that. These companies have a long runway of growth spanning many, many years. And after 5 years from now or 7 years from now, their revenue and profitability, particularly in the quick commerce segment, is something that that is difficult to comprehend at this point of time. So the numbers, the results from these segments will continue to be good, and the market will start responding positively towards that. So that is one segment which investors should be focused on. Another point that I would like to emphasize is in one video that is I think more than a year back, I mentioned this point. I would like to repeat that. A major trend in the market, a paradigm shift that is happening in the financial sector is the financialization of savings. People are transforming from savers to investors, right? So more money is coming to the market. When more money is coming to the markets, we know in April 2020, total demat accounts was around 4 crores. Now it is north of 18 crores. So with this kind of new demat accounts getting opened, new individuals participating in the markets, and the monthly SIPs is now more than 25,000 crores, 25,300, I believe, last month. And there is money coming through the insurance companies, bulk investments in mutual funds, pension schemes and all that. So this financialization of savings is a very strong and structural shift that is happening in the market. And the beneficiary of this financialization of savings is the capital market. Capital market has been growing, and the capital market will continue to grow, not for 6 months or 1 year or 2 years, for many years to come. And capital market has now large number of stocks. There are stock exchanges, there are depositories, there are stockbroking firms, there are asset management companies, there are wealth management companies. This did not exist a few years ago. Now Bombay Stock Exchange is a stock that you can buy. MCS is the exchange you can buy. Indian Energy Exchange, IEX, is an exchange. CDSL is a depository. HDFC, AMC, UTI AMC, Nippon AMC. These are asset management companies which you can invest in the market. Then there are wealth management companies, stockbroking companies. All these are beneficiaries of this financialization of savings. Market knows that. Market has already positively responded, and therefore the price movements have been very strong and positive. I would again repeat, there is no valuation comfort in this segment, but if you are an investor with a time horizon of 3 years and above, this is one segment which can give excellent returns to investors.
So to summarize, basically, it should be more of a stock-specific strategy that investors should look at. And plus, the two sectors that you mentioned that you can look at is basically in the digital space as well as the capital market players.
Exactly.
So thank you very much, Dr. VK, for your insights. To conclude, what would be the message that you would like to share with our investors, especially considering the maturity that they've shown in the last 2-3 months? Because earlier it would have been a huge downside to the markets, but now we feel that our investors are also more mature when it comes to investing in the market. So your concluding statements to our investors?
I'm very happy about Indian domestic investors coming of age, even though I am very unhappy about many of them dabbling in the F&O market and losing big money. I am really concerned about that, and we have been warning them about that. But the investors population that is increasing, particularly I am happy about this steady growth of the SIP investments, and also our dependence on foreign money, foreign capital flows is declining. Formerly, everyone was looking at FIIs as smart money, but now domestic investors are smarter than the FIIs, and that has imparted a lot of resilience also to the market. So my request to the investors should be to continue with systematic investment plan, because markets have always an uncanny ability to surprise, because the sharp up moves in the market, down moves in the market also will come at the most unexpected time, and you can never time the market. So be a patient investor, invest for the long term. The India growth story is very much intact. Don't be unnerved by the small dips in the market, even if it is a 5% or 10% or more, because the India growth story is very much intact. We are all familiar with the saying, to make a fortune from the market, you need only two things: an average person's intelligence, which all of us have, and 10% patience, which most of us do not have. So this is what I have to tell the investors. Be patient, invest in the market for the long term. You can laugh all the way to the bank.
Thank you very much. Thank you very much, Dr. VK, for your valuable insights.